Welcome again, everyone, to this Hidden Gems webinar. Now, last week we spoke about the online brokerage industry, and there's some kind of further updates on this because this week Robinhood filed for an IPO, and for the first time we get a look inside the business model that is free brokerage, and the numbers are incredible. Now, remember, the Robinhood economics kind of works like this. You've got Robinhood clients looking to buy and sell stocks, options, and cryptocurrencies. And it's very profitable to be on the other side of these trades, believe it or not. Now, smart algorithmic trading firms want to be on the other side of this retail flow, and they pay Robinhood for the privilege. Now, in the first quarter of this year, Robinhood had $522 million of revenue. That's for one quarter. Now, of that 522 million, 422 million was payment for order flow from market makers. Now, Robinhood's main business is actually convincing people to trade options. And in the first quarter, $200 million of Robinhood's revenue came from payment of options order flow. That's against 2 billion of options sitting in Robinhood's client accounts. So Robinhood's making about 10% on the value of its customers' option portfolio. That's why it's free. Add this to the fact they offer clients margin lending. They lend out their stock for short selling, and then there's cryptocurrency. Now, Robinhood made about $88 million in the first quarter of this year on crypto, of which 30 million came from Dogecoin, a crypto originally created as a joke. Now, at the end of the March quarter, Dogecoin was trading at 5 cents and volume was around $774 million worth a day. And that occurred on the last day of March. Now, in May, post Robinhood's end of quarter reporting, in May, Elon Musk pumped Dogecoin on Saturday Night Live, and it finished May at 74 cents. Volume in the crypto rose from that $774 million a day to having one day in April trading at $68 billion worth. So how much has Robinhood made in the second half of, or the second quarter of 2021? No one knows, but it looks to be in the hundreds of millions of dollars. Now, the scale of this is frightening, given Robinhood has 32 million subscribers on its podcast and newsletter, numbers ShareCafe can only dream about. Now, all this I mention is to help investors understand their risk and to really understand nothing comes for free. Righto, let's make a start. Remember, all the recordings of these webinars can be found on ShareCafe and also our YouTube channel. Don't be afraid to ask questions. Type them in the green box at the bottom of your screen. First up, we have Argenica Therapeutics, ASX code AGN, market cap of 15.7 million. Hasn't got a one-year return, just newly listed. The company is developing novel neuroprotective therapeutics to reduce brain damage after strokes. We have with us the CEO, Dr. Liz Dallimore. Liz, over to you. Thank you.
Thanks so much, Tim, and thank you for having me. So I know I've only got 10 minutes, and as you said, Tim, we are newly listed on the ASX. So really what I want to do today is give viewers just a bit of a sort of snapshot of who Argenica is and what we're trying to do and what the sort of the roadmap looks like for the next 12 to 18 months. So as you said, we are newly listed and we are looking to develop best-in-class novel neuroprotective therapeutics. So these therapeutics will provide protection to brain cells following stroke and other types of brain injury. So these brain cells are usually irreparably damaged following stroke or other brain injury. So we're looking to protect those brain cells. The project itself has been in development for over 6 years with significant capital spend through external grants as well as philanthropic funding. Our lead candidate is ARG-007, and it has shown evidence of efficacy in multiple models of stroke and other types of brain injury. So through our IPO, we raised $7 million, and we will use that money to advance our phase 1 clinical trial and commence our phase 2 clinical trial. Next slide, please. Thanks. So this is our capital structure at IPO. So we had a market cap of 14.6 mil, and you can see a number of shares there in escrow for either 12 months or 24 months. We're sitting around the 15.7 market cap today with a share price of 24 cents. Next slide, please. So we've got some key investment highlights. So what we are trying to do is solve a huge unmet clinical need. There are currently no drugs on the market that provide protection to brain cells following stroke. And Argenica hopes to be just one of a handful of companies that address this unmet need. As I said, our lead candidate, ARG007, has been in development for over 6 years, and we've got fantastic preclinical data showing the efficacy of our drug in not only stroke, but other types of brain injury. We've got a really experienced board and management team with both capital markets experience as well as drug development commercialisation experience, and a really clear clinical pathway to get our lead candidate through to phase 1 and on to phase 2 and phase 3 clinical trials. Next slide, please. So as I mentioned, we are addressing a huge unmet need, and the opportunity that we're looking at is projected to be a stroke treatment of around $183 billion US dollars by 2030. So around 15 million people suffer a stroke every year globally, and with 5 million people that die of stroke. The most common type of stroke is an ischemic stroke. So around 85% of people that suffer stroke will have an ischemic stroke. Ischemic stroke is caused by a clot in the blood vessels in the brain. There are currently, as I said, no drugs on the market that protect brain cells following stroke. So any type of stroke, including ischemic stroke. So we are looking to develop and commercialise our lead candidate to address this market need. Next slide, please. So why is neuroprotection so important following stroke? Stroke is one of the leading causes of death and disability worldwide, and it generates a huge economic burden on the healthcare system. When somebody has a stroke or other type of brain injury, brain cells suffer significant damage, which is often irreparable. And the time to treatment is absolutely critical. So we know that the brain ages around 3.6 years for every hour that treatment is delayed. The current stroke therapies only address the underlying cause of the stroke. So for an ischemic stroke, which is caused by that blood clot in the blood vessels in the brain, the treatment at the moment really looks to remove that clot. So that's either done by a procedure called a mechanical thrombectomy, which surgically removes the clot, or by administering a drug, which dissolves the clot. And that drug is called alteplase or TPA. Next slide, please. So just to show you a current sort of stroke treatment and then where our lead candidate hopes to play in this. So currently when somebody has a stroke, paramedics arrive and determine that that person has suffered a stroke, and the in-field triage that paramedics can do is reasonably limited. So their whole goal is to get that patient to a stroke care unit at a hospital as soon as possible. Now, when patients arrive at the hospital, it's really important that the type of stroke that they have is diagnosed. So either an ischemic stroke, or the other type of main type of stroke is a hemorrhagic stroke, which is caused by a bleed on the brain. Now, the reason this is so important, because if the clot dissolving drug, that TPA drug, is given to a patient that's had a hemorrhagic stroke, it can exacerbate the bleeding of those stroke patients and even result in death. So once it's determined that someone's had an ischemic or a hemorrhagic stroke, the treatment for ischemic stroke, as I said, is either to remove the clot surgically through a mechanical thrombectomy or to administer TPA, the clot dissolving drug. But you can see that all in that delay of getting diagnosis and treatment, the brain is still deprived of oxygen because of the clot, and that you get increasing levels of neuronal cell death and damage in the brain, which leads to long-term functional disability for stroke patients. Next slide, please. So what we're hoping to do is to be able to administer our lead candidate, ARG007, at the point of paramedics arriving, so in the field. So this will give patients greater time to reach hospital and to receive treatment. So our lead candidate, ARG007, acts as a neuroprotector. So it protects the brain cells from dying. So it delays the amount of cell death seen in these patients, thereby reducing the amount of cell death and improving the amount of functional recovery in these patients. Next slide, please. So what our data shows is that in animal models, so we've done extensive preclinical work in animal models to show that ARG-007 reduces the amount of infarct volume. Now, infarct volume is the volume of cell death that is actually seen in the brain. So we can see after 24 hours post-stroke, ARG-007 is significantly reducing that amount of cell death. And we've compared this to our nearest competitor, NA1, which is currently in phase 3 clinical trials. And we've shown that this effect of neuroprotection from ARG-007 lasts significantly post-stroke. So we've done up to 28 days after that stroke, and that neuroprotection still remains. Next slide, please. So importantly, what we've also shown is that within a hemorrhagic stroke model, ARG-007 does not exacerbate bleeding. So this means that it can be given to a patient before diagnosis, so in the field by the paramedics immediately. So it can start working to protect brain cells as soon as a stroke has occurred. Next slide, please. So Argenica is following a very standard drug development pathway. So we're at in the process of completing our preclinical studies required for our phase 1 clinical trial. A phase 1 clinical trial is a trial to look at the safety and tolerability of a drug in healthy subjects. So we will do this trial first before we move on to our phase 2 trial, which will look at the efficacy of ARG-007 in patients that have suffered a stroke, and then move on to a larger efficacy trial in our phase 3 trial. Next slide, please. So this just outlines our development pathway over the next sort of 12 to 18 months. So we are in the process of optimizing our GMP manufacturing. So that's our good manufacturing practice. So that's the type of drug that we need to move into our clinical trials. We've recently released some preliminary PK or pharmacokinetic data, and we'll complete those studies middle of Q3. We are also about to embark on our safety and toxicology studies in non-human primates. So this will be completed just before we initiate our phase 1 clinical trial, which will be initiated towards the end of this calendar year in Q4. We'll look at first patient dosing soon after that and have preliminary results from our phase 1 clinical trial towards the beginning of Q2 2022. Next slide, please. So as I mentioned, we've got a really experienced board and management team. So our non-executive chairman, Jeff Pocock, who has extensive experience in capital markets, is a non-exec on Osteopore, Envision, and was a former co-founder and managing director of Hazer. Jeff is joined by Dr. Samantha South, Liddy McCaw, and Terry Budge on the board, and myself as the CEO, and we're joined by Emma Walton as our company secretary. Next slide, please. And we are fortunate to be joined by leading research and clinical teams. So our Chief Scientific Officer, Professor Bruno Maloney, has over 20 years of experience in stroke research. And he is joined by our clinical lead, Professor Neville Nucky, who has a fantastic experience of both neurosurgery as well as research. So they are leading the research efforts for Argenica. And our clinical advisory committee, who is advising the company on the structure of our clinical trials, so led by Dr. David Blacker as the chairman, Professor Jeffrey Donnan, Paul Bailey, and Dr. Tim Phillips, who all have extensive experience running clinical trials in stroke, with both David and Jeff involved currently in our nearest competitor, Nono, who've got the NA1 drug in their phase 3 clinical trial. Next slide, please. So just some key takeaways before I finish up. So we're a really well-structured business, really robust capital position and currently well priced. Huge commercial opportunity to address that unmet need in stroke patients, and really value enhancing milestones coming through in the next 12 months, which is really exciting. So that's it. Thank you very much, Tim.
Thanks, Liz. A couple of questions here.
Yep.
We've seen a number of biotech companies recently that are focusing on unmet needs kind of get fast-tracked designation from the FDA. Is that something you're looking to push?
Yeah, we can definitely look at that sort of that fast track designation. And that's sort of, if you're not sort of familiar with the process, something that you apply for. So every biotech has the opportunity to apply for and look at it on its merits. So it's definitely a key strategy for most biotechnology companies.
And to get to this stage, it's probably taken 6 years by the sounds of things. You've spent some significant dollars. Your funding channels to date have been external. You've had grants and some philanthropic funding. Can you give us a few more details on who's supported you this far?
Yeah, so look, generally the way, because it's come out of a research institute, so the majority of funding does come from NH and MRC grants, so they are federal grants. And then the parent institute has significant philanthropic funding as well. So a number of those philanthropic donors are actually some of our early stage investors into the company as well. So mainly high net worths that have a connection to neurological conditions.
And you've spoken about administrating your drug in the field before the stroke type has been determined. We've had a couple of companies on the webinar previously, EMV Vision and MicroX, who are developing kind of portable brain scanners to help determine the strokes in the field. Is this sort of technology going to help you in any way?
It's all fantastic. The sooner that you can diagnose stroke, and if you can do that in the ambulance, then you can triage that patient in the hospital quicker, right? So it's going to come through that the interventional radiologist will know that patient has had an ischemic stroke, so they can go straight into surgery. So that's fantastic to reduce the time, but because our drug can be delivered regardless of the type of stroke, it doesn't actually really matter for us. And I think it's all complementary, right? It's all about getting the patient to the right treatment as soon as possible. But really what our drug is trying to do is to buy that patient time and to protect their brain cells as much as possible before they receive the treatment.
And is this question here, is the ultimate aim of the drug to be administered for immediately after trauma, like a car accident or rugby concussion, or is it just kind of, does it have additional uses post-stroke use?
Yeah, absolutely. So we've got preclinical data in traumatic brain injury as well as perinatal hypoxia. So they're the two avenues that we're looking to build upon with some of this funding through the IPO. So traumatic brain injury, which is more sort of aligned to something like a car accident, is what we're looking at. Concussion is a mild traumatic brain injury, and they're sort of quite different neurological models. So we're looking at both of them. If you think about concussion in a sporting injury, that occurs multiple times over a player's professional career. So we're looking at what would be the right kind of dose, what would be the right kind of formulation if we can build it into, say, a nasal spray or an oral formulation where a player can take that as soon as it's sustained a concussion, and potentially a lower dose if they're going to have chronic use of the drug as well. So all those sorts of things is what we're looking at to explore over the next 12 months as well.
Great, Liz. That's all we have time for. Really nice of you to introduce the business, and good luck. We'd love to have you back on towards the end of the year.
Would love to be back. Thanks, Tim.
Thank you. Next up, we have Zelera Therapeutics, ASX code ZLD, market cap of $57 million. The company is a global therapeutic medicinal cannabis company with access to the world's largest and fastest growing cannabis markets. We have with us Dr. Yilderi Odomusu. Yilderi, over to you. Thank you.
Thank you very much, team. It's a pleasure to be here. Just very quickly, I am going to tell us about Zelera Therapeutics and why we are a value-driven company in the cannabinoid science space. So Zelera is a very unique company because across the board, we are a quintessential biopharmaceutical company that is focused on developing medicines from cannabinoids, from the cannabis plant. So we are not we don't grow, we don't process, we don't dispense cannabis in the parlance of of the industry, you say, we don't grow pot, we don't do weed, but we create proprietary medicines, we validate them clinically, we commercialize them. And what's very beautiful about Zelera is that we're doing all of that, and we are fast tracking. We have a model by which we can fast track the development of these drugs in the right markets, and we are generating revenue while doing that. So the takeaway from Zelera is that we are a biopharmaceutical company doing hard science clinical research on cannabinoid-based products out of our Australia program. We have access to the world's most emergent or fastest growing market for cannabinoid-based medicines, where we can validate those medicines, commercialize them, generate revenue, and drive value with a focus on therapeutic needs that are very important and unmet. So very quickly, over the next few slides, I want to share with you what we do at Zelera. We've really broken our play at Zelera into two aspects, where we focus on the primary, what we call the Rx play, that is based on drugs that we formulated, and in most cases patent protected. We've clinically validated, we're commercializing, but they contain the THC, which is tetrahydrocannabinol from the cannabis plant. In markets like Australia, where cannabis is legal on the federal level, we're able to conduct classic clinical research and commercialize them. In markets like the United States, where we have more than 35 states with either a medical and some form of adult use program, what we do is we are able to do that through licensing. The second arm of our business, and one more point about the Rx part of our business, is it gives us medium to long-term value, both for the company and for our investment community. The second part of our business that is very interesting is that we play in the OTC, or over-the-counter space, where we can develop hard science-backed products that are derived from cannabinoids from hemp. And in the markets where we can commercialize those directly, it gives us control. We generate revenue both in the short, medium to long term. So as we go through the rest of the slides very quickly, I just want you to keep in mind that Zelera drives value both in the Rx and in the OTC space as a biopharmaceutical company focused on cannabinoids. Next slide, please. So Zelera is already generating revenue from multiple streams. The first one, which I will talk about very quickly, is our Launch and Learn program. I'll speak about that just quickly. Those are Rx focused, where we're able to launch a product into the marketplace with a focus on specific indications such as autism and age disorder. With regards to autism, we already have 2 products coming out of that program that are already commercialized in the United States and in Australia. Prescribers and patients can access them, and they're generating revenue. On the OTC side, we took a focus on the oral care product, and the first iteration of that is a toothpaste that has been launched both in the United States and has been licensed and launched as well in the UK. In that space, we're already generating revenue as well. Later this year, the Zelera Dermatology program will be launching 5 additional products, 5 new products coming out of that space, and will start generating revenue for us as well. In addition, 2 very interesting focus that puts us very squarely in that biopharmaceutical space are our clinical trials, which I will discuss very quickly. We've already read out the first of which is our insomnia study, which gives us to date the world's most advanced clinical data on the treatment of insomnia with cannabinoid-based medicine. We've also read out results from our opioid sparing studies, and we have studies ongoing in autism. And later down this year, we've communicated some additional very deep pharmaceutical focused research on chronic pain and GI-related issues. Next slide, please. So very quickly on the launch, learn, and develop model. This is one of the models that allows us, especially in the United States, because of the program in the United States where where by fiat and by law in some states, we can, the state has already pretty much told us a list of conditions. Take Pennsylvania, for example, in the United States, where cannabis has already been approved for treatment of up to 23 conditions. There we can immediately formulate a product based on the hard science, launch it into the marketplace, partner with the right groups that are affected or use the product, learn about how the product is impacting the conditions or impacting quality of life, take that real world data, and we can then do one of two things. We can either use it in additional product development or use it to improve the products that already been developed. Because we have access to the only country in the world where we can do clinical research on cannabis and then do R&D work and be reimbursed for it, which is in Australia, we also have that option to pipe the further development of that product into our Australia program. So this is how we can rapidly commercialize products into the marketplace. And we've done it with a target on autism. This slide is really here just to show you that the market opportunity is large. And we are already playing in 3 of these markets. I just to illustrate, it's a very, very, very large market. We play in Australia, we have footprints in Germany, and we have access to the world's largest commercial market for cannabinoid-based medicines, which is the United States as well, and other global emerging markets. Not only is Zelera very, very busy developing drugs, commercializing them, we're doing that in multiple countries at the same time. In 2020, Zelera is a company that was born through a merger of Zelera Therapeutics and Zelera Therapeutics in January of 2020. And in just the last 15 to 16 months, Zelera has launched 6 products in multiple countries, in Australia and in the United States, as well as executed distribution deals in the UK with footprints and our eyes on the emerging German markets. So we're busy launching products, generating revenue, clinically validating them, and doing it across multiple markets across the world. Next slide, please. Very quickly over the next few slides, remember I said to you that Zelera has a 2-pronged approach. We are developing products, commercializing them in the Rx space and in the OTC space. Within the Rx space, we developed Hope, a range of products that target cluster symptoms associated with autism. Since we launched this product in the United States, we've gathered real life data, published this into a white paper based on our launch, learn, and develop model. We've been able to take this product across multiple state programs in the United States through licensing deals that are lucrative to Zelera and generating revenue, but also take that packet and do a tech transfer to Australia, where this product under the auspices of the TGA Special Access Program is available to prescribers and patients for autism. This is a very, very important market for us because the space of autism spectrum disorder has one of the largest signal to noise ratio. Ask a parent or a ward with a child with autism, they'll tell you that your therapy works or not in relatively short order. We've been very pleased with the results we're seeing. This product continues to expand. Next slide, please. Still within that Rx play is our drug called Xenobor. Like I said earlier, this is the world's most advanced drug for treating chronic insomnia that is cannabinoid based. We read out the results from our clinical trial. It met its safety and efficacy endpoints for insomnia. This product is launched in Australia. It is available again under the special access program to prescribers and patients. It is generating revenue for us, and we are looking to expand it into other global markets. The market is very huge and unmet for insomnia, and this product holds great promise. Switching very quickly to the OTC side of our business, we focused on partnering with groups that have a hard science background and commercialize products in the space. Remember, I said we can directly commercialize this. So we've done this in the United States. We've done this in the UK. Next slide, please. Later this year, we've taken a similar approach to partnering with Dr. Karen Grossman, who some argue know as, they call her the dermatologist of the stars in the United States because of her background in cosmetic dermatology. With that platform, we will be launching 5 additional products called under a brand called RAV5. Next slide, please. These products will target, next slide, please. These products will target the treatment of acne, and we've created 5 products based on a unique technology that allows us to address this unmet but very large space. So as you can see, next slide, please. At Zelera, we've been very busy over the last 15 months, as we've said, from clinical trials all the way through generating revenue and licensing deals. Next slide, please. And this is a snapshot of our company. Next slide, please. And our team. So the takeaway here from Zelera is that we are an Australian-born company. We're a revenue-generating company. We're a biopharmaceutical company that is developing drugs, commercializing them, generating revenue, and driving value for our investment community. And we are backed by a very strong board. I serve on that board, but people with great experience in biopharmaceutical, in finance, and who have been successful and have a track record in this space. With that, I thank you for inviting us, and I will turn it back to Tim for questions.
Derry, thank you very much. Now, we've had a few medicinal companies on recently. We know it's a competitive sector. And obviously, medicinal cannabis has multiple applications, which you spoke about. How do you focus on one part of that application? Is it a focus on revenue?
It is a focus on therapeutic areas that have value by impacting the quality of life of patients. So you can generate revenue, you can be successful when you focus on an area that has impact. And by doing that, when you impact a space like autism, you in return are successful, but you do that by doing good.
And obviously a very different market, autism to insomnia. How do you go through the regulatory process in regards to something, in regards to autism, for example?
Well, it depends on where you are. So in the United States, where by fiat, we have multiple states that have a medical program or a medical and an adult use program, is very, very different from Australia, where at the federal level, you can actually conduct traditional clinical trials. So depending on which space we play and the therapeutic area, we have multiple tools at our fingertips. Like we said, one is our launch, learn, and develop model that allows us to rapidly commercialize products, but also is the traditional clinical trials where we did a phase 1B, phase 2 study under the auspices of the TGA, which is a first world regulatory body. The beauty of that is then, regardless, let me take a focus on the Australia model where we can do traditional clinical trials. The credibility of that data then allows us to be able to really build a dossier that has a potential to be valid in other highly regulated markets.
And just one more question. To accelerate the commercialization of various products, do you partner with cannabis firms to source quality controlled ingredients and manufacture, or do you partner with drug majors to get big distribution channels?
That's a very, very, very good question. So the focus, first of all, is on quality and premium products. So all of our products are, let me take Australia, for example, are manufactured in Australia, CGMP, under both manufacturing and distribution partnerships. In Australia, we've partnered with TASAC, known as Extractus, to manufacture our products under CGMP, and it goes through the same regulatory processes and rigor, and then are distributed based on partnerships that have access in those markets. One of such relationships is with Health House, that distributes our products in Australia, with a footprint in the UK and in Germany as well.
Great. Thank you for all your time. We've got a couple more questions, if you don't mind following those up online. Have a great weekend.
Thank you very much for having us.
Next up, we have Celsius Resources, ASX code CLA, market cap of around $40 million, 1 year return of up 100%. The company is an exploration and development company with a portfolio of world-class copper gold assets. We have with us the Executive Director, Blair Sargent. Blair, over to you. Thanks.
Thanks very much, Tim. Okay, so one of my favourite quotes that I just feel compelled to include in any presentation is from the head of Trafigura back in March, which was a comment that said, I'm not sure about the commodities super cycle, but I'm 100% sure about the copper super cycle. I think since that comment was made, the market is well and truly aware of copper's role in this global transition to net zero. So as it turns out, it's a wonderful, wonderful place to be. And I'll talk about those assets in due course. Another comment, and also something of a bit more substance really, is there is a little bit of apprehension around the Philippines, which is the focus of our efforts with our copper gold assets. So it's important to recognise that recently the president of the Philippines a decree which essentially lifted what was a 9-year ban on new mining projects. So from our perspective, we're very, very confident about the fact that despite some of the reputational issues of the jurisdiction, the fact of the matter is they have a very well-established mining industry, and the president has certainly made some changes at law which facilitates projects like ours proceeding. So we're pretty confident about where we're heading. Again, I'll talk about that in a bit more detail. All right, so the main, I guess, summary of Celsius and where we find ourselves. We have a portfolio of copper and gold assets in the Philippines, as well as a cobalt asset in Namibia. The focus is certainly the copper gold. As I'll talk to shortly, there's certainly plenty of value in the cobalt asset as well. As it stands, our flagship project, the Mcb Copper Gold project, over 90% of that JORC resource is already classified as indicated. It's over 300 million tonnes, grading at circa 0.4% copper. As it stands, again, that represents over 1.5 million tonnes of contained copper, and not far away from 1.5 million ounces of gold. Currently, we have a drilling program underway. We also have a scoping study that's underway and due towards the end of Q3. We're very much focused on the development of that first asset as a primary objective. We see ourselves not as an exploration company, therefore, but definitely a development company. We're looking to bring that first project into production. As I mentioned, we've got other assets as well, which include a second copper gold asset in the Philippines, which is called Sagay. And we also have the Upuru Cobalt project in Namibia. Very important to note that from our perspective, we have a really, really strong team with a deep experience in country in the Philippines, which we see as very important in terms of overcoming this partial negative perception of the jurisdiction itself. Importantly, the chairman, which again, I'll give a bit more detail, but Martin Buckingham, who's leading the company, has been operating in the Philippines for over 30 years, and that includes a 25-year stint with a company called Atlas Consolidated, and Atlas is the largest copper producer in the Philippines. Martin spent over 17 of that 25 years in an executive capacity, senior vice president and/or CFO. So he understands the jurisdiction very, very well. Obviously, that means in terms of the asset base, we provide investors with long-term exposure to copper, to gold, but also to cobalt. Last point to make, this group of assets that were recently acquired in the Philippines are all ex-Freeport. Freeport were one of the largest, or still one of the largest copper producers in the world. And importantly, they spent over $45 million specifically on this portfolio, which is now owned by Celsius, and we are certainly enjoying the benefit of that historical spend. Okay, so as I mentioned, Martin Buckingham, absolutely critical. That's 30 years experience in the country, including 25 years, as I mentioned, with the Philippines' largest copper producer. Obviously myself, Bill Oliver, who's been around for quite some time within the board of Celsius, so a lot of background with the Apuru cobalt asset. Nene, just quickly worth mentioning, non-executive director based in Manila, very much part of that in-country team that we are relying on. Deep experience as well, not only obviously in country as a Filipino, but specifically in the mining industry as it relates to environmental and the regulatory environment. And also we have the in-country director, just on the next page, please, which is Peter Hume. Again, been living in Manila for over 15 years, an engineer by profession, and most recently came from a project called Tampakan, which was once owned by Xstrata/Glencore, and that's one of the largest undeveloped copper gold projects anywhere in the world. Next. So just some specifics about the Mcb project, being our flagship project located on the main island of Luzon. And as you can see there, just from that small map, surrounded by lots of well-established resources and mining projects. I think the main takeaway here, though, as I had touched on previously, was that this is once owned by Freeport, and Freeport spent over $14.5 million specifically on this asset. And in the first instance, as I mentioned, we're certainly going to enjoy the benefit of that historical spend, and that's reflected in our Maiden JORC resource on the next page, which we released not that long ago, which currently stands at over 300 million tonnes at 0.48% copper, 0.15 grams a tonne gold. Over 290 million tonnes is already classified as indicated. Now, our focus is certainly on what we've defined as a high-grade core, which currently stands at 93 million tonnes at 0.8% copper and 0.28 grams a tonne gold. So the asset is absolutely tier one from our perspective. As I mentioned before, what that resource represents is over 1.5 million tonnes of contained copper and very close to 1.5 million ounces of gold. Also, as mentioned, Maiden drilling program is underway. The first hole has already been completed. The focus of that program, it's a 6-hole program over 4,000 meters. The first 2 holes are into the high-grade core, and then the balance of the program really is to potentially expand the resource and also just test the boundaries of that resource as well. Again, scoping study also underway, which we're hoping to publish towards the end of Q3. Going on to the next slide. That's just a quick little map and a picture depicting the resource. As I mentioned, the first hole of that drilling program has already been complete. We've announced the assay results, and as you can see there, highlighted in yellow, which is the recent hole, the intersection of copper was over 600 meters at 0.4% copper and 0.08 grams a tonne gold. More importantly, the intersection within the high-grade core, which was the focus of the hole, returned results 7.85 meters at over 1.4% copper and 0.36 grams a tonne gold. The focus, as I mentioned, of the first 2 holes is very much on that high-grade core, and what we're looking to do is to ensure continuity of grade and that first hole certainly achieved that objective. Those first two holes that we're currently doing, the first hole finished, the second hole close to finished. In fact, it is finished. We're just waiting for the assay results. I know it says there we're at 380 metres. In fact, we ended up drilling to about 630 metres. And all we're doing now is waiting for the balance of that core, the last 200 metres of that core, to return the assay. So we expect that in the next 2 to 3 weeks. But the main focus, as I mentioned, the first two holes into the grade core. So we're just looking to firm up grade and continuity of geology as well, with those two holes and the results thereof also being incorporated into that scoping study, which we're looking to publish towards the end of Q3. Next. Okay, so just a recap here. As I've mentioned, a long history with Freeport, over $14.5 million spent specifically on this project. Drilling program underway, first hole complete, first hole assays released, second hole complete, second hole assays due in a couple of weeks. And then the next objective is to publish the scoping report, which should be done by the end of Q3 this year, all things are going according to plan. Thereafter, we'll obviously finish the balance of the program, which is another 4 holes, and we're expecting that to be done towards the end of the year, and then we can update in total the global JORC resource for this project, which may or may not result in an expansion of an already very large and high-grade resource. Thereafter, for 2022, the idea being, on the basis that the scoping report is positive, the numbers are robust, we'll immediately launch into the process of the DFS and all the other work streams associated with achieving a mining license, either in the form of an FTAA or an MPSA, which is the relevant path to a mining license in the Philippines, which we're hoping to achieve sometime by the end of next year. Just moving on. So other projects. So number 1, the Mcb Copper Gold project, also in the Philippines on the island of Negros. Again, Freeport asset, ex-Freeport asset, I should say, spent over $10 million, over 25,000 metres of drilling. And as you can see, they've just highlighted some of the historical results. Where we're at with this particular project, we're looking to renew the permit in the first instance. Having done that, which we expect imminently, we will then move on to an exploration program, which is targeting some infill drilling for the primary objective of being able to release a maiden JORC resource on this particular asset as well. Highly prospective, historical results look good. So we have pretty high expectations for this as well. And then very quickly, moving on to the cobalt asset, just want to mention here that this is an asset we inherited in terms of the deal with Celsius. Recently upgraded the resource, doubling it in size, over 200 million tonnes at 0.12% cobalt, 0.43 copper, and 0.54% zinc. Key takeaway here that this represents over 259,000 tonnes of contained cobalt, in addition to nearly 1 million tonnes of contained copper. So for a cobalt asset, it has substantial resources in relation to copper as well, and we look forward to progressing that particular asset in due course, which we hope to release some details to the market shortly in that regard. Next as well, please skip that one. All right, so just a quick snapshot there of the corporate structure. Current closing price, I think as of today, or trading price, 0.036. So as was mentioned, market cap circa $36 to $40 million. We recently did a capital raising towards the end of March, or early April, I should say, of over 6 million. So closing cash as of 31st of March, pro forma, 8.2 million. Plenty of cash to execute on those objectives that I've mentioned. So we're very bullish about the assets that we have. Obviously, the market is very conducive right now for copper and cobalt and gold for that matter. So we think we're well placed, and certainly we've got the team to be able to execute on these assets and move them up the development curve, which we're looking forward to progressing, in due course. So that's pretty much it. We'll try and wrap it up there. I know we're a bit time constrained. So Tim, any questions? Shoot.
There's questions. Thanks, Blair. First question I suppose you'll always get is, why did Freeport abandon the project and how did you pick it up?
Yeah, so it's a bit of a long history, but they essentially walked away from the Philippines in 2012. So I think there was probably a couple of key reasons. The primary one being, despite the fact that Freeport was the largest copper producer at the time, I think they ended up investing substantially in oil and gas. That didn't actually turn out very well for them. The share price lost circa 70 to 80% of their value. And that caused, as it often does, and those circumstances, a refocus by Freeport, and in the end there were casualties in all of that, and this asset or group of assets was one of those casualties. They essentially just walked away cold from the Philippines. The asset ended up in the hands of a Filipino geologist by the name of Noel Ferreira, and Noel used to work for Freeport as the head of geology, and since 2012 he's had those assets. He's never had the balance sheet to be able to develop. And as I mentioned, given Martin's history, the chairman, long history in the country, he was aware that Freeport had walked away. He knew Noel, and it just took quite some time for Martin to progress those discussions whereby they essentially agreed to do something with them. And what we've done is certainly married, obviously, the asset with the cash and the vehicle, which is Celsius. And that sort of coincided as well with Martin moving from an executive to a non-executive within Atlas, which essentially paved the way for him to strike that deal without creating any unnecessarily conflict with Atlas. So that's sort of a brief little snapshot of that history. I think, you know, the old Celsius board, as it were, the one that was responsible for doing this transaction, deserve a pat on the back, because these assets are absolutely significant. They are tier one, and it's a huge opportunity. And I think Celsius have done well to secure them.
There's a question on that, technical question. I know we've got a mining analyst on board here. Given the moderate to lowish grade resource, can the resource size expand a lot? And could you comment about metallurgy? Are the metal recoveries expected to be high?
Yeah, so first things first, I wouldn't necessarily agree that it's low grade. I think that if we go back to the total resource, which on the face of it may not look overly impressive, being 300 million tonnes at 0.48%, but as I mentioned, the high grade core is the focus, and that's running closer to 1%. So within that high grade core, 93 million tonnes, over 70 million tonnes is already indicated. So and running it, as I said, around about 0.8% copper plus 0.3 grams a tonne gold. So those grades are quite significant, and they certainly stack up very well against most of the majors in terms of what it is that they're mining in terms of both size and grade. So we're very comfortable with that. And if you look at, you know, what you might be able to do with 70 million tonnes at those grades, that is more than enough to justify a relatively long life mining operation. That will be borne out in the scoping study. So we'll sort of wait till that's done and dusted and we can publish those results. In terms of metallurgy, that's also one of the key work streams within the scoping study. So there's nothing to say right now about that metallurgy. That will all come out in the publication of the scoping. The main point, I guess, to mention though on that is the first two holes, as I said, into the high grade core. Part of that core is being assayed in the Philippines. The balance of the core is then being sent to ALS laboratories in Perth for the very reason to put that core through the relevant metallurgy tests. So we'll have to wait for those results, but we certainly don't expect, given the nature of the deposit, any surprises in terms of what that may or may not look like.
Right, Blair, that's all we have time for. Have a nice weekend, and we'll catch up with you again later in the year, hopefully.
Yeah, good on you, Tim. Thanks for having me.
Thank you. Next up, we have WT Financial Group, ASX code WTL, market cap of around $12 million and a one-year return of up 100%. The company is a diversified financial services company. We have with us Keith Cullen, who is both the founder and the managing director. Over to you. Thanks, Keith.
Yeah, thanks, Tim, and thanks everyone for joining us. As Tim says, I'm Keith Cullen. I'm the founder and MD of WT Financial Group, or WTL for brevity today. firstly, today, let's have a quick look at what the agenda is. I'm going to give you some background on WTL and then take you through what's happening in financial advice in the industry and the disruption in the industry before talking to our acquisition of Century Group Proprietary Limited and looking at some peer comparisons and, if time permits, running into Q&A. For those of you that don't know WTL, we were founded in 2010, originally under the name of Spring Financial Group, and our complete focus was on building a diversified financial services offering to consumers. So we were a B2C, direct-to-consumer business with all salaried advisors. And we enjoyed great success and were profitable from our first year of operation. And our success was really founded on building a great range of assets and intellectual property around advisor education and training, as well as consumer education, and a process-driven approach to advice creation and risk management. And we also built a fabulous suite of client recruitment and digital marketing tools that we originally listed under the ticker of SFL in 2015 under the profits test. And we had a very strong dividend history, paying out around 7 million in dividends. Fast forward from there to 2017, and significant changes to legislation and regulation, education standards, and the Royal Commission all impacted considerably, not just on the industry, but on our company. And it forced the board and its shareholders to have a rethink. And we determined that we would be best placed to bite the bullet and shift our thinking from being B2C focused to being a B2B operator. And we felt this would enable us to leverage the assets and the intellectual property that we developed through our journey of building a very successful B2C operation. So this strategy saw us dispose of a number of B2C assets and scale back our fixed overhead to pivot to being predominantly B2B. Central to that pivot was our acquisition of a dealer group known as Wealth Today. And Wealth Today, like other dealer groups, provides a range of services to advisors who, rather than being salaried advisors, are independent business operators who act as authorised representatives. Those services include licensing, compliance, education and training, tech support, practice management, and business development services. And look, our primary driver for this was that in the wake of the Royal Commission, we saw what became a very rapid unravelling of the traditional vertically integrated model, where the banks had acquired all of the sizable dealer groups in the country and used them to aid their distribution of products. And I'll talk some more later or shortly to explain just what the scale of that opportunity is that this unravelling of that integrated model, vertically integrated model, has presented. When we acquired Wealth Today, it had just 42 advisors. And by leveraging the assets that we've built, that's enabled us to grow organically to 120 advisors now in just 3 years. Those advisors are across around 105 practices. We've seen significant increases in revenue, and concurrently we've managed to rationalise our cost base, and we've done further of that across the last 6 months. So what we did was we bit the bullet, and we've turned the impact of industry disruption on the company on its head and turned it away from being a burden on us to rather as capitalising on it and being one of the disruptors, and certainly one that's now presented with incredible opportunity. So it's easy when you look at the advice business in Australia at the moment and look at the headlines in the newspapers with the banks abandoning the playing field of financial advice to question why you might be investing in the space. Well, the key to this is demand for advice is growing, not diminishing. We're on the doorstep right now of the largest intergenerational wealth transfer in history in this country, with $3.5 trillion of wealth about to pass from one generation to the next over the next 20 years. And what this is doing is it's really increasing the complexity of the advice required around this wealth transfer, forcing advisors to upskill to address that complexity. The demand for more complex issues like estate and legacy planning, retirement income advice planning, for aged care advice, and of course for strategic investment advice for the recipients is all growing. And this presents enormous opportunities for companies like WTL at a time when others are abandoning the playing field. From the perspective of an individual advisor, they need the support now because of this increased complexity. They need a strong dealer group with the right infrastructure in place to help them deal with the upskilling that's required for this increased demand and the increased complexity. And this is marginalising smaller, low-cost dealer groups also, presenting further opportunity for both organic growth and transactional growth. When you look at the Royal Commission, it has had a big structural impact on the industry. And you might read of advisors leaving the industry, about banks getting out of the space, being spooked by the Royal Commission. Well, we saw this same thing in the UK after their retail distribution review. We saw consolidation, a reduction in the number of advisors. We saw certain players leave the industry altogether. And therefore, initially, we saw a downturn in value in the industry and in total revenue. But this quickly turned around in the UK. And over the last several years, as we've seen a significant growth there, averaging about 9.4% per annum, clearly well ahead of CPI. And that's the turnaround and growth of the industry as it consolidates and resets to modernise that we're taking advantage of. So quickly looking at, we're going to skip that slide. We're going to move on now to our acquisition of Sentry. So I talked about our success in acquiring wealth today and turning it into something of some reasonable scale. We're now leveraging that scale through the acquisition of our industry peer, Sentry Group. Sentry was originally founded in Perth, but it's a national dealer group today. It's been running for 17 years or 16, going on to 17 years. And it's a very transformational acquisition for WTL. Sentry has 155 advisors across 95 practices. And over the last few years, Sentry has done a terrific job in evolving and modernising its business for what the landscape looks like today. So it's a natural fit with where we've arrived at with WTL also. Their real focus has been on assisting advisors in growing their practices. And this is something that is really important on the advice landscape today. Having a look at the transaction, we are paying $7 million, which will be satisfied by 50% shares, 50% cash. And we're raising an additional, or we have raised an additional 1.5 million in cash as well to deal with integration costs and the costs of the acquisition. We've done all of this at 7.5 cents, which represented at the time we did the book build a couple of weeks ago, 25% premium to the last trade price of WTL when we went into a trading halt for the book build. And the book build within 24 hours was well oversubscribed, well more than $1 million above what we were seeking to raise. So we were delighted with the support, and I think it really underscores the value that people are seeing in how accretive this acquisition is. The acquisition will settle Monday week on the 19th, following a shareholder meeting on the 16th, which is next Friday. We've already had more than 75% of shareholders vote, so all of the resolutions will be carried with the votes that we're holding thus far. The acquisition results in 2022 revenue guidance of around 70 million and a net profit after tax guidance in excess of 2 million. So post-settlement, using a 7.5% share price, it gives us a pro forma market cap of 21 million, looking at a very conservative PE ratio on that guidance of 10.5 times. Within WTL, you've got a very committed group in charge. Board and management holdings to combined are some 36% of the company. This is a really highly complementary and very transformational acquisition for us. It brings terrific scale and efficiencies. The board and management team will be expanded. I'd urge you to have a look at our previous announcements for further detail on that, because time doesn't permit today. We're taking significant steps to restructure our balance sheet as at the 30 June balance date we've just had, and we provided a good deal of detail in our most recent announcements on that. And this will ensure we've got a really clear runway to deliver that strong profit in FY 2022. And we're very motivated to see a return to dividends that we expect to be able to get back to after 2022. Significantly, post-acquisition, we will have around 275 advisors across 200 practices Australia-wide, and this makes us a very significant player in a new crop of independent heavyweights that are emerging in the country. So we'll just have a quick look at those, and you can see what I've been talking about here of the majors, what we call the big six abandoning the playing field. You've seen a real transference of advisors out of that institutionalized model, with NAB and CBA, Westpac and ANZ basically disappearing altogether. AMP and IOOF, the two institutional models remaining, but collectively they're all down 54%. And you've seen the emergence of ourselves and others into this crop of the top 10 independent or non-product focused, non-product producing groups. And at 275 advisors, you'll see us, these numbers are fluid, obviously, as they move about a little bit. These numbers for our peers are all based off the latest money management report from late last year. But you'll see us emerging there in that sort of top 3, 4, 5 of the non-aligned or the non-institutionalized dealer groups. And you'll see within that crop, there's a few privately held businesses in Synchronized and in Capstone and Lifespan. And then you'll see some of our industry peers there in Sequoia, Centrepoint Alliance, Count Plus, and Eastern. What all this says is there's opportunity for further organic growth, no question, as we've demonstrated ourselves in the last couple of years, going from 40 to 120 advisors. But there's also significant opportunity both at the smaller end and this larger end for acquisitions and mergers within the industry. So I think that brings us to the end of the presentation. I promised Tim I'd keep it under 10 minutes, and I think I've managed to do that. What I'd say in concluding is that our guidance of $2 million net profit after tax, or at least $2 million of net profit after tax for FY 2022, is based on our existing revenue run rates for both Sentry and for WTL. So we're not factoring any growth in those numbers. The vast majority of that revenue is recurring or recurrent, around 90% in fact. We've worked so, when you look at that 7.5 cent pro forma multiple of 10.5 times, I think it really reflects very positively for the opportunity for significant share price appreciation over the next 12 months and beyond. We've worked very hard to align ourselves to take advantage of the disruption in the industry and in fact become one of the disruptors. Demand for advice keeps growing in Australia. So with this opportunity, I think we're very well placed for the future. Thanks, Tim, and thanks everyone for joining us. If there's any questions, I'd love to answer them.
Yeah, thanks, Keith. So we are seeing a lot of advisor movement. Can you talk to, is your strategy to grow organically? Are you seeing a lot of advisors you're picking up individually, as well as looking at these larger transactions? Is that part of the strategy?
Yeah, it's a dual strategy, Tim, most definitely. It's a very fluid market. There's still advisors exiting the market that's creating consolidation at a practice level. And there's a lot of advisors that are fed up with being part of this institutionalized sales network that are really looking for their next move. And for many of them, as they're aging, it'll be their last move. So the opportunity for organic growth through having a best of breed offering, which is what we deliver with the combination of both Sentry's assets at a granular practice level and the frameworks in consumer education and advisor education and training that we've built, and the risk management framework where we're turning risk management and compliance into an asset for advisors. I think we've got the best of breed offering in the marketplace. So we're looking forward to really strong organic growth. But then there's acquisition, transactional growth, not only at that larger level, but also as these smaller operators with the low cost bases just can't compete with the demands that advisors are placing on them now.
And can you had that slide about the UK experience in 9.5% growth. Do you see that extrapolating into Australia?
Yeah, absolutely, I do. And look, we're seeing it already with asset appreciation, the asset values going up, and we're seeing it in a lot of the fees in the game being asset-based fees. That's helping drive revenue up. Just because advisors are retiring and just because banks are exiting the market doesn't mean clients don't need advice, and doesn't mean when an advisor retires, he's not just shutting shop and handing his clients over to no one, he's selling them. So yes, this consolidation's happening, but we expect the size of the industry to continue to grow, and in fact for that growth to accelerate.
And can you talk to, post this acquisition, can you talk a little bit more about the board and management that's been brought on as well?
Yeah, I can. I skipped over that because I wanted to keep it short on time, but just at an executive level, really key, David Newman, who's the Chief Executive of Sentry, is joining us as a Joint Chief Operating Officer. He'll share that responsibility with our COO, Frank Paul. David will run West Coast operations and really focus on that organic growth, the business development that he's so good at. And Frank will run the East Coast operations on a day-to-day basis and keep focused on that risk management framework that we've really perfected in helping advisors see compliance as an asset rather than a liability. Jack Standing, who's with us, will broaden his responsibilities across the group as head of advice. And then we've got Shelley Radford and Rickton Jones, respectfully head of legal and head of finance from Sentry, joining us. So it really strengthens the board, the management team. At a board level, we've got Michael Harrison joining us as a non-executive director, and he's one of Sentry's shareholders. Michael was very involved in the bringing together of the Shadforth group that was listed on the ASX and ultimately sold out to IOOF. So he's got great financial services experience. He'll be joining Guy Headley and Chris, my fellow founder, Chris Kalesas, and myself on the board. And then Rob Jones, who is also a Sentry shareholder, and again was an ex-Shadforths and involved in mergers and acquisitions with Shadforths, is joining us to head an internal advisory committee on a non-exec basis. So we're really excited about the broad management team and the depth of the skills there.
And just finally, Keith, you're confident about these 2022 numbers? I mean, you're talking about $2 million net profit after tax on a new market cap of around $20 million. I mean, at some stage that becomes a very attractive dividend yield, doesn't it?
Yeah, look, it certainly does. And when you look at the depth of ownership of the executive and the management, you can see how our interests are very aligned to shareholders. When you look at our dividend history, you can see where our intention is to take this company, and it's back to a dividend paying company. Yes, it's a big turnaround, but when you look at the size of Sentry and our ability to really leverage the cost base of bringing these two businesses together, we're super confident on it, Tim, is that we're not forecasting, a hockey stick of revenue to get us there. We're basing these numbers off where we're both at today with that recurrent revenue. And we know exactly line by line what the cost base is looking like to deliver. So yeah, we're extremely confident on that guidance that we've given.
Great, Keith. We'll finish on that note. Thanks for your time. Have a good weekend. There's actually a couple more questions, if you don't mind answering those online. Thank you.
Absolutely. No problems at all. And thanks, everyone. We appreciate it.
Thanks, mate. See you later. That's all we have time for. See you next week. We'll be back with more companies to present on this Hidden Gems webinar. See you then.